Well, the Federal Reserve is raising its key interest rate by 0.75%. The short-term rate now stands at 3.25%, which is the highest rate since the 2008 housing market crash. Fed Chair Jerome Powell says the increase is necessary to bring down inflation. You're joining us now for more insight on how this move will impact our wallets is Chris Markowski, the host of Watchdog on Wall Street. Good morning, Chris.
Good morning, Andre.
So is this a case here of raising interest rates like this on a regular basis? Is this a case of short-term pain for long-term comfort?
Well, it's perspective. That's been a word that Jay Powell's been using for a while. He sounds like Mr. T in Rocky III, prediction, pain. And quite frankly, I don't necessarily agree with the way that they're thinking things. We've ended up turning things into a bit of a binary choice where it's either we have inflation or the Fed has to knock people out of work, raise the unemployment rate, and crush the economy, which, harkens back to the Vietnam War. We need to destroy the village in order to save it. I understand that we have to deal with inflation. I think that there's other ways that we can do it. I think we need to deal with the supply side as well. The Fed is already winding down its balance sheet, which is going to be a big help. But if we actually got some help on the side of the government, help on the supply side, and make it easier for businesses, and maybe actually institute some tax cuts and getting rid of some regulations, I think we'd be in a much better spot. It would be less pain.
So why so much attention being paid to raising the key interest rate? I mean, what's wrong with some of the ideas that you've put forth? Are these not ideas that are accepted?
Well, again, conventional wisdom can be poison, and everyone's been told the same thing for decades. And you get a bunch of economists out there, and people learn it in business school, and there's business cycles, and the Fed has to lower rates and raise rates, lower rates, and rinse and repeat. I don't think that that's the case. I think part of the problem is whether you go to Washington, D.C., both sides of the aisle like to spend a lot of money, and they never want to rein in government. Whenever we hear, oh my God, we're going to hit the debt ceiling, we must go through the debt ceiling because, oh my God, the government's going to shut down. Why don't we get government under control and actually live within our means and balance the budget? People fail to realize this 75 basis point hike, let's say if it helps inflation and the prices come down for us, which I hope it does. However, we're still going to pay for it on the back end. Our borrowing costs as a nation go up, meaning we're going to add almost $2 trillion to our national debt by the 75 basis points over a 10-year period of time. That's just in higher interest costs that we're going to have to pay. And again, we're going to pay one way or another. At some point in time, we have to live within our means.
Okay, we're going to pay long term, but we are also going to pay in more immediate terms here. There's gearing up to be a real impact here on employment. Help us understand why some jobs have to be sacrificed to slow down inflation.
And I don't believe in that theory. I mean, again, this has been pretty much what we do as a society. But again, we got right now the employment market is very, very tight in this country. Still, you look at the JOLTS report, there are 2 job openings for everyone looking for work. I know we have, 2 political parties that love to bang heads with one another, don't want to work with one another. We might want to deal with the immigration problem and finding some way of getting some of these people that are coming here, finding a way, a path. There's a Republican congresswoman from Florida out of Miami that's got a 15-year strategy to help bring these people into the workforce. The manufacturing groups this past week were actually suggesting apprenticeships and also dealing with immigration and helping to get some people into the workforce, because that will help ease inflation as far as labor costs are concerned as well.
It seems like there's a path, but 2 sides here, they're arguing and government can't seem to get on the same page. But there seems to be some ideas out there to get things to go a little bit smoother than the way they are now. All right, so we talked a little bit about the jobs issues. The higher credit costs will also be one of the issues here. What are some of the other consequences that don't immediately come to mind about what the Fed is doing?
Well, everybody knows, credit card interest rates are going up. So again, I would highly recommend for people out there, if you have credit card debt, which you don't want to have, I know that certain times bad things happen and you have to utilize it and kind of spend. You want to make sure that you may want to be able to get refinance that with another card to try to lower rates for a period of time and pay that down because they're coming up. We all know that the big one everyone keeps talking about is mortgage rates, which are above 6%. Now, again, I'm showing my age to some degree and how old I am. The first home that I bought years and years and years ago was 7.5%, almost close to 8%. So rates have been up here before. However, this is going to drive the prices of homes down. It's going to take some time. There's some lag to it. But again, most people buy a home based upon what a monthly payment is. So if the interest rates go up, then obviously the price of the home has to come down, the principal.
All right, let's take a look at the stock markets right now. All the major indices, the S&P, the Nasdaq, Dow, all down right now. Do you expect the volatility to continue? In fact, we're looking live at the New York Stock Exchange. Stocks down 113 points. Tell us what you think.
Yeah, I do think that we're going to continue to see a lot of volatility. I think people kind of waiting for the next shoe to drop, and it's called a bit of a buyer's strike when you have situations like this. I would encourage people not to be buying in and looking at your statements on a daily basis, monthly basis, whatever it may be. If you've got a good financial plan set and you own high quality companies, guess what? You're going to get through this. I mean, there's been difficult periods of time. I've been in this business for decades that have happened again and again and again. You're gonna go through it now. You're gonna go through it again. If you're smart and you don't do silly things with your portfolio and make drastic changes, if you own quality, you're going to come out on the other side doing just fine.
In other words, the cycle continues. We go through it every few years or so. Chris Markowski, host of Watchdog on Wall Street, thank you so much for joining us and providing your expert insight with us this morning. We appreciate it.